Well, I'm here with Jim O'Shaughnessy, Chairman and CEO of O'Shaughnessy Asset Management. Thank you for joining us this evening.
My pleasure. Thanks for having me.
Great. Let's just start off by asking, what has been your firm's biggest achievement in the past year?
Well, I think this year our biggest achievement was successfully spinning out of Bear Stearns Asset Management. Okay. We had been running a little over $10 billion there in equities long only, and came to a relationship, an agreement which was very friendly with Bear Stearns, which is unusual in the industry.
Of course.
When you are actually parting company and going on to your own firm. Right. But the stars all aligned, and we managed to spin our company out with $10 billion plus in assets under management. Bear is a minority stakeholder and remains our second largest client. So it's a very amicable relationship that we have with Bear Stearns and the asset management arm of Bear Stearns. But it was a lot of heavy lifting during the last year, and I can say mercifully that is all now behind us, and we can look forward.
Great, great. How's it been going on your own these past
Well,
few months?
we had an unusual situation in that, you know, we're in excess of $10 billion in long equities only. So if you look at where that puts us in the league tables, it makes us a fairly sizable equity only long shop. So
right.
We were able to do things that a startup, for example, couldn't do.
Of course.
We were able to engage folks like Mellon for a back office. We were able to bring some very high caliber personnel to the firm right away. Okay. For example, we have as our performance analytical person, the person who used to do it all for Neuberger Berman.
Oh, okay.
And you know, our controller used to be the controller for Legg Mason. So the firm was able to draw a very high talent pool, which was great for us, and so far so good.
Oh, great, great. What's your biggest concern about the mutual fund industry right now?
Well, I think, you know, the mutual fund industry, obviously the granddaddy of managed accounts in the United States. And I think that right now there is a lot of speculation about the roles of ETFs, for example, right. The roles of separately managed accounts, and just the proliferation of a variety of different types of funds. Mm-hmm. I think that that being said, if you look at the ICI printouts on the mutual fund industry and the health of the mutual fund industry remains extremely strong. I think that the categorically the average investor wants their money to be managed by a professional manager. And if you look at the way the market segments out, you know, the mass affluent, those with net worths in the $500,000 range, right. Really their best solution remains a mutual fund. Okay. And so within that group, you know, you take the big providers like Vanguard, Fidelity, et cetera, you know, they're going to be the preferential choice of that group. Okay. And I think that, you know, you also see some of the traditional mutual fund providers like Vanguard come out with Vipers, come out with a lot of their own ETFs. So I think that they're reacting to those sort of concerns in the marketplace.
Okay. What about the whole debate over actively managed ETFs, which seems to be contrary to the whole spirit of ETFs?
It's an interesting concept, isn't it? We sort of our style falls in between active and passive management in that we're quantitative advisors. Right. So in fact, 10 years ago, we called what we did strategy indexing. Okay. We took a strategy, which was certainly not an index, but we implemented it with the discipline of an index fund. Okay. And so I wouldn't be at all surprised to see ETFs going that way. I am a little surprised to see ETFs going the full actively managed route, because it is a bit of an oxymoron, right. That, you know, these are supposed to be passively managed index-like funds, right. And suddenly we're going to be putting the sleeve around an active management product. So I think that the jury's still out on how those are going to fare. But you know, I think the beautiful thing about our industry is that it's extremely innovative, and as ideas come down the pike, if they're implementable, right. You know, you'll see them.
Right. Yeah, for sure. Somebody will do them, right?
That's right. Okay.
And where do you see the industry headed in the next year or so?
Well, I think that, you know, there's been a sea change since the turn of the century in both the need for and desire of advice. I think that we are in a completely different market environment now than we were in the 90s, when anyone could make a fortune in the market simply by buying anything.
Right.
And I think that if you look at where we've been during this decade, actually this decade in terms of real rates of return is coming in to be the second worst decade in 110 years. If you look at the real rate of return to an S&P 500 proxy, you see that it's down about 1.7% per year for all 8 years. The good news of that, however, is that normally after that, it's in the past, if you go back to 1926, or with some other data we have back to 1900, it's generally during periods of near bear market lows that's the occurrence. But my point of it is the idea that you could just pick anything and have it work died in 2000. Yeah. If you look at an asset allocation portfolio that had some exposure to small cap, to value, to growth, that portfolio fared extremely better during this very difficult period. So we think that, that certainly is in the brain of the investor. And the investor is out there understanding, you know what? Maybe I can't do this on my own. Maybe I really do need that mutual fund manager. Maybe I really do need that advisor who's going to build me an asset allocation. So from our perspective, we think that the next 10 years are going to be absolutely, in 2030, they're going to be looking back at the golden age of money management. Wow. Because all the boomers getting ready to retire, they need help.
Right. Okay, great. Well, Jim, thank you so much for taking the time and joining us tonight.
Appreciate it.